You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday. Time for your mega dose of options education here on the network. And we kick it all off, as we are wont to do, with the premier educational program for options traders out there. Of course, talking about your favorite Options Bootcamp. My name is Mark Longo from the aforementioned network, as well as, of course, from the ever-exciting optionsinsider.com. Got a lot more coming at you over there and on the network in the coming weeks and months. So stay tuned. A lot of fun tweaks and upgrades coming your way very soon. Maybe kicking off with a big shindig next week. So stay tuned for all of that fun. And of course, wherever you're getting this content, we're seeing so many great reviews coming in from so many different platforms. Sometimes it's just amazing how many platforms carry our stuff. But wherever you do get our stuff, could be the big ones, could be your iTunes, your Google Podcast, your Spotify's, maybe more some of the smaller ones like this Podbean, even though that's growing out there now too, or Audibles, or maybe you have a third-party platform like a Pocket. Wherever you get it, keep rating and reviewing. If you use our app, keep using the App Store to rate and review. It really does help all the new folks discover all the content that we do around here these days. Of course, keep those questions and comments coming too, even though I don't need to tell the audience of this show that you guys are hot and heavy with the questions. We could probably do all questions all the time every week and still not really get to the bottom of that barrel. But we love it. Keep them coming. If for some reason we don't have a chance to answer them on this show, we'll make sure you're answered on another show. So everyone gets their questions answered. That's why you got to listen to the full network, by the well. And helping me answer those questions and tackle all these tough, twisted, tricky options concepts. How many T's can we throw in there, Mr. P? It's none other than Mr. Dan Passarelli, the founder of Market Taker Mentoring, former market maker down there in the dark, swirling pits of the SIBO, and indeed author of one or two options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Oh, Mark, I'm excited to be back. We've got great stuff to talk about today.
We do. Speaking of talking, I mentioned the market makers. You know, I've talked before. I was in the SPX and Intel and a few others. What pits were you in? I don't think we've ever discussed that here in all the years you've been doing this show.
I was mostly in the Ford Motor Company pit.
Oh, you were a Ford man. So are you still trading a little Ford? I don't do much legacy Intel as I used to. I used to do a lot of Intel. I don't do as much anymore. Are you still slinging Ford? It's been a little more active of late these days.
I'm always watching it, but I'm just I'll trade whatever's making money, man. I like to say, give me an EKG chart, I'll trade it.
There you go. Well, Bitcoin's looking a little bit like that right now, maybe a little bit on the downside. So maybe you're slinging some of that. Let's see what folks are slinging, though, because it is time for a little bit of basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out. Do you hear me? Yes, sir. Basic to complex. Yes, sir. There will be no failures. Do you hear me? Yes, sir. Pull in. Yes, sir. Prepare to
everybody. Let's get to it. A little bit of the old basic training, the portion of the show. We take an options concept and explain how you can use it in your own portfolio. Sometimes we take iterations upon said concepts. Like right now, this one was inspired by a question from Evoc92. They want to know, hey, Drill Squad gurus, new listener alert. Oh, well, welcome to the program here. Evoc92, you are far from alone. A lot of new folks discovering boot camp and indeed the network these days. It says, loving the show. Well, thank you. We love you in return. You guys are making my transition from stock trader to Zen Options Master. Dan, I think you like that one. Zen Options Master. I mean, that's the title for your new book. What do you think? Zen Options Mastery. What do you think, Dan?
Yeah, I'll get a shadowy picture of me sitting in lotus position at the top of a mountaintop.
Stroking your beard. I like it. Maybe a little bit of a Doctor Strange vibe. Zen Options Master. I can kind of go for it. You maybe have given us some inspiration here. Evoc92. He says, yeah, my transition from stock trader to Zen Options Master. So much easier. Thanks so much. I enjoyed the episode on Covered Calls Revisited. That was something we talked about recently on the show here, listeners. He says, I've taken Mark's advice and focused my early options trading around covered calls. So far, so good. I'm up 6.2%. Well, glad to hear it, Evoc. Yeah, I think this is... I know other people have other ideas, but I think for a lot of beginners, particularly coming from the way you are, from owning stock and being long stock, covered call is a great segue into options trading. Speaking of segues, he continues here. My one area of trouble seems to come when it's time to take them off. I don't really have a firm grasp on when to close my covered calls. Should I let my stock get called away? Should I roll? When should I roll? Any help to clarify my approach would be most appreciated. Thanks again. You guys are over 5-star rock stars. I'm thinking 10 or 20 stars. Dan, I don't know if the iTunes other outlets allow for 10 or 20 stars, but we'll take it. What do you think?
Yeah, sure. I mean, I'm all for sticking extra stars on the end of that.
You know, this is a topic we've touched on in the past, but again, as we just kind of revisited covered calls, it's also worth revisiting this because, again, so many new folks trading options out there these days. But it's an interesting topic, Dan, and one that I think is fun to discuss. I know you have your methodology over there in the land of MTM. So when someone comes to you and they're saying, hey, I have these covered calls on, what should be my approach to taking them off? What do you usually tell them?
Yeah, we teach a very rigid methodology, the MTM Smart Income System. And the way that works is you have to consider that, like, if you just make one covered call trade one time, like, you might win, you might lose, it doesn't matter. If you have this as part of an ongoing system and you're constantly rolling and constantly working through within this system, it becomes super powerful. So yeah, most of the time, well, first of all, should you let your stock get called away or should you roll? When you first start out with a covered call, you should know the answer to that question before you even put it on. Like, are you trading the covered call because you want to basically work a limit order to sell your stock, and if you don't get filled, you get to keep the premium? Is your objective to trade out of the stock or to skate on it and keep the premium, in which case you would most likely want to roll? And so, yeah, so rolling is typically the most common thing that I do. I mean, I've been doing this on my SPY position in my IRA for like years, and it's mostly just constantly rolling. There was a couple times when I let it get called away, but I just waited for a pullback and wrote some puts because that's part of the system too. So yeah, keep at it and think of it always as one complete system. One trade is just one cog in that wheel.
Yeah, there's a lot of ways to approach this. Let's start with the example we used in our last show, and we'll kind of work from there. In our last show, we talked about XYZ, everyone's favorite name, trading at $100. You're long 1,000 shares from 70. You're long from $30 below. So congrats to you. You're sitting on a cool 30 grand. So right now you're thinking, yeah, maybe the stock might languish, but you also think maybe you might be comfortable selling it at 110. And that's a key point. We're going to come back to that in a second. So in our example we talked about last time, we sold the 110 strike 1 month out, covered call, and we got $1 for it. It's pretty juicy. Probably not going to get $1 in the real world, but it's not bad. It's pretty juicy nonetheless. So now what did you get for that? Of course, the multipliers on your equity options are 100. So every one lot you do is for 100 shares. So in this case, he has to do it against 1,000 shares. So he needs to do 10. So you're making $1 times 100 times 10. So you're making $1,000 in premium. That's not bad. That's a cool 1%, right? For what you're sitting on out there. So not bad. And you can do it for 1 month. And now, of course, the question our listener has and what we're talking about here is what happens when it gets to that strike. So in our example here, let's say the stock closes on expiration at 111. So your calls are now in the money. You're $1 in the money. So guess what? Your stock's going to get called away. Your options are in the money. They will be automatically exercised. For our sake of our example, it closed exactly at your break even. Remember, you collected $1 for that. So your effective selling price of the stock is 111. Now, in our case, this person should be pretty happy. He made $41 on his investment. He's over 50% up on his investment. So in this case, you should be happy. And that's something I want to get in your heads first off. If you're writing covered calls, especially for a lot of the audience of this program, you're new to this. You're doing this kind of for the first time. You're kind of getting your training wheels on from an options trading perspective. Getting your stock called away is a good thing. That means you win. That means you won on this. And now, if it's a GameStop and it blows 1,000 handles through it, maybe not. But in most scenarios we're talking about, most reasonable scenarios, you write an out-of-the-money call, your stock that you hold appreciates to that level, and it gets called away. Hey, pat yourself on the back. You win. So I think for a lot of the beginners of this show, we could put it at that level. You should identify a level where you're comfortable selling the stock. And then write the call on that strike. Now, the key to this is really to be honest with yourself. It's very easy for people to say, I'm comfortable selling it. And then you get closer to that strike and all of a sudden, I don't know if I'm comfortable selling it. And that's where a lot of the wiggle room comes in. So at the beginning, treat it like a sell order in an equity. You guys do that all the time. You do limit sell orders all the time. Say, hey, I'm going to sell this stock at 110. Treat it as you worked a limit sell order for 110. But hey, because of the options foo, you got an extra $1 in your pocket just for using options as opposed for using the stock to do that. So take advantage of that, but treat it like that. You get to 110, you're out. And now you could, as Dan said, that doesn't mean it's the end of your trading. Just that stock position has closed. Now you can do a lot of different things. You can do what we've called before on this show, the wheel trade. Maybe you want to get back in at a lower strike. You wouldn't mind buying that stock back at a much lower strike. Well, as Dan said, you turn around and sell the put, working effectively a limit buy to get back in at a lower price. If the stock drops, you buy it back. You do the whole thing over again. It's called the wheel trade. Get paid to get in, get paid to get out. If you do nothing else with options, listeners, if you come to this show and you do nothing else, you're not going to do calendars, you're not going to do verticals, you're not going to do anything else. If you just use options to get paid to get into your stock positions and then get paid to get out of them, you're doing all right. You're outperforming the vast majority of people out there who have no concept of how to use options, let alone in conjunction with stocks. I think for a lot of you who are just starting out, I think it's okay to leave it there, to say, okay, I've identified a level. Be honest with yourself. And it may require you to sell a little bit farther out of the money than you wanted or ordinarily, but that's where you're comfortable selling the stock. And that's okay. And if it gets there, you make all the appreciation plus the premium you sold and you're out and you're happy. You live to fight another day. You move on to the next trade. Now, rolling. This is a different scenario. This is something that involves usually a couple of things. First off, as I mentioned before, and this is where it gets dangerous, this is where it gets subjective and very fuzzy, your outlook on the stock may have changed, right? And now you're saying, well, they just bought something and they created a new widget. And now they have all these new markets. They acquired something. Who knows? But something fundamentally has changed with the stock. I'm not talking the stock just went up. I'm talking something fundamentally has changed to really make you think, you know what, this is the new beast. Perhaps I need to readjust. I don't want to get out here anymore. So that's category one. And the second category, which is also very common and could affect a lot of the audience of this show as well, is they can't sell it either because they don't want to take the tax hit, which is a big one, or it could be you have some sort of, probably less for the audience of this show, but maybe you have some sort of legal prohibition against selling the stock. It's something you're involved with, something along those lines. So first off, if you're in category 2, you're worried about the tax hit, or you can't be selling the stock and for legal reasons, then you should be taking that into consideration when you're writing your call, and probably also migrating your liquidity a little bit farther out of the money. Either that or you're going to be really aggressive on the roll, right? If you want to give yourself some breathing room, a little bit farther out of the money, give yourself a little bit more wiggle room so you're not going to have to worry about falling asleep at the wheel one day. You're busy at your job. Next thing you know, your stock's called away and you're, oh my God, I forgot. All right, so these are scenarios of why you might want to roll. Now, rolling. Let's talk about the rolling itself, getting back to the original question. This is something, as Dan mentioned, and I firmly believe this as well. These are rules you need to establish at the outset of the trade. So you're putting on this covered call. You're selling, in our case, the 110 strike covered call. In our case, we wanted to get rid of the stock, so we don't need to roll. But let's say we're tax prohibited. We can't. So now we have to start working on our rules ahead of time. And that gets confusing. I get why you're confused. There's a lot of different ways you could measure that, right? You could measure the change in the initial options premium that you sold, the change in the options delta that you sold, how far away from the strike the underlying is. There's a lot of different ways to go about this. So, Dan, I know you have some pretty clear rules you like to use when you're setting up your rolling criteria over there at MTM. So why don't you walk some of our listeners through those and how you guys like to approach it from the outset of the trade, and then as you get close to the strike, what do you guys do?
Yeah, so approaching it from the outset of the trade, I set my objectives, skate or trade. My objective to skate is I want to skate and not get a sign. My objective to trade is to get a sign and trade out of the stock. And for me, most of the time, it is to skate, at least with the spiders that I've been doing this on for years. And what I do is if the stock goes through the strike price, I simply roll, and I typically roll up and out. And that's very, very simple, very, very straightforward, not complicated. Like, you can't mess it up, really. If the stock goes through the strike price, I roll up and out, which means up to a higher strike to give myself more room to run, and out to a further out expiration. And it's beautiful doing that with spiders because I can roll out 2 days if I want to, which typically I do in those scenarios. And the thing to consider, and this is where most traders get hung up and confused and run into trouble and give up on it, is don't be afraid to take a loss on the call. And some people say, oh, no, but I'm leaving money on the table. I could have made more. Don't worry about it. That's why I say you have to look at it as part of a system. Basically, like, if you think of a stock as like a financial engineer thinks of a stock, you think of it as having basically a log normal distribution with fat tails, right? Which is a super fancy way of saying the stock could go up or the stock could go down. In the times that the stock goes up, what your objective really is just to break even on all those covered call trades. Like, sometimes it goes up and it doesn't quite go through the strike price, and that's great. And sometimes it goes up and it gets just to the strike price and you kind of break even. And sometimes it goes through the strike and you have to buy it back at a loss. But if you just break even on the call portion and keep the profits on the stock every time it goes up, and then every time the stock stays still or goes down, you make money on the calls. Like, you will outperform what you're doing, and you will outperform the average investor. And so that's a very, very important concept to understand.
Yeah, I think it's important too to keep it simple, especially again for the audience of this show. So if you're not going to be that person who's going to take that approach of you're selling the call at the strike where you're comfortable selling the stock, then if you're going to want to adjust, then I think the strike price is nice. I agree with Dan on that because it's not really a moving target. You start getting into things like delta or premium or any of these other things. They move, obviously. Delta changes. All these other things change. So it's a bit of a moving target of when you should roll. The strike is fixed. The strike's not going anywhere unless there's some crazy corporate action and the options are adjusted. But outside of that very aberrant scenario, your strike price is fixed. So that's a nice thing. It's a fixed goalpost. So having that strike where you say, if once the stock crosses through it, I am going to roll. I think the key, Dan mentioned it as well. Don't just roll up. If you're doing in the weeklies, maybe you go out another week. If you're going in the monthlies, maybe you go out another month, something along those lines. Keep the time frame relatively similar, but giving yourself more time is also important for that as well. And I know a lot of you, maybe that isn't attractive to you, but I think for a lot of people, yeah, you're going to sell that premium a little bit farther out. And it's going to get you a little bit more bang for the buck. Rolling vertically, I've never liked that. It seems like it's just kind of spinning your wheels to not really get you a lot. Give yourself more time to get a little bit farther out of the money as well. And at the end of the day, remember, the main engine of profit in a covered call trade is the appreciation on the stock. It is an income trade, but if you look at any sort of back test or analysis of covered calls, in fact, we just did a great one on our last episode of the Advisor's Option with Matt and the folks over there at ORATS who do just that. They back test all these different strategies. And we talked about the optimal structure for a covered call in that. If you want to check out what a great optimal setup that works great from a back tested period, go. If you're not subscribed to our network, subscribe to the network. And then go check out our Advisor's Option program. The most recent one, I believe it was called the Majesty of the Covered Call. We break all this down in a lot more detail. At the end of the day, most of the back tests you run show that the lion's share of the gains from a covered call come from the appreciation side. So give yourself some room to run on this and let yourself have some time. So rolling up and out is better than just rolling straight up. So there you go. What was the name of that listener there? Evoc92. I think for a lot of our listeners, maybe including you, if you're just starting out, I think it's fine to let your stock get called away. If you're in something like Dan's in, where he's in SPY and he has a much longer term horizon to it, you can always use it. You can always start rolling as well, or perhaps you're tax restrained as well. And for rolling, don't get fancy. When it breaks through your strike, roll up and out. Give yourself some time on that as well. And you get a little bit more juice for it. That's not the worst thing either out there. So there you go. Some basic rules of thumb. Hopefully that'll help you with your covered call trading out there. And speaking of you folks, it's time to bring you onto the show. It is time for your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you guys take the reins, your questions, your comments. Since things are so crazy, so topsy-turvy, especially out there in the market right now, lots of red on the screen. People need a little bit of love. Dan, are you ready for a little bit of love, sir?
I love love. You know that.
We're still waiting for that haiku, sir. Anytime you want to surprise us with your epic haiku about love, have at it. All right. Today's listener love comes from, I don't have the name, actually, because it comes from one of those other platforms to talk about, Podbean. A lot of people listening on Podbean now. If you like it out there, hit us up. We love to hear from you. This just says Option Bootcamp 134, leverage diagonals, and the wrong way to start trading options. That was I do believe our mail call palooza episode from last episode. And he just says, I love you guys. Entertaining and informative is just the beginning. Well, there you go, Dan. A little bit of love. How are you feeling now? You feel better about yourself? I know you were a little down coming into the show today. Does this lift your spirits?
Oh, it sure does.
I know you're mad about all your Bitcoin holdings taking a drubbing today, so this maybe hopefully will lift your spirits. Speaking of Bitcoin, we have a fun poll out there right now. You can play along with our polls. They're usually pinned on our Twitter profile there at Options Listeners. If you can't find them, just scroll down a little bit. It's our question of the week. This week's question of the week, given all the red on the crypto screen, we said, is this a momentary blip or a sign of things to come? Quite simply, if you could buy a 10% out of the money call expiring at the end of the year, December 31st, on one of the following crypto underlyings, which one would it be? Gave you the big dog Bitcoin, gave you Ethereum, gave you everyone's favorite or least favorite Doge, the infamous Doge, or equally infamous other. And a lot of interesting chiming in on this one. Some folks, Queen Shiba, aka Shiba Inu coin, got some votes. XRP getting more love. We talked about that on our crypto rundown this week, at least earlier this week. I haven't checked it today, but I know earlier this week it was one of the few crypto underlyings that was really kind of bucking the trend and weathering this storm pretty well. I'm not sure if that's still the case. I think it's down to $1.40 now, but still nowhere near as far down as some of these other names out there, or have some others. Dan, I know you're sad about your Bitcoin holdings, but if you had to buy a call on one of these for the end of the year, A, do you have a vote? And more importantly, what do you think our audience is voting for?
Oh, man. You know what I would select is Ethereum. Because I feel like Ethereum has more, like the actual blockchain of Ethereum has more utility than Bitcoin has. Because, I mean, look, like any asset has a price associated with it that stems from its value. And, right now, cryptocurrencies don't really have any value. Like, there's very few things that you can spend it on. And so, the price is arguably just an arbitrary store of value that may or may not work out one day. And that's basically what Bitcoin is. Dogecoin started out as a joke and probably still is. And then the smaller ones, there's a bunch of wacky ones out there. But Ethereum really has, there's a whole bunch of stuff built on there for smart contracts and, all that. So Ethereum definitely has more staying power and more actual intrinsic value.
Yeah, I'm with you. I definitely would choose ETH of this bunch out here as well. Taking a drubbing this week, but previous weeks had almost doubled just in the past of the last couple of weeks, gone from around 2,000 to over 4,000. So ETH had quite the run. It's probably hard to argue that a little bit of a pullback isn't warranted given just the extreme effervescence of the rally out there in crypto. It seems like a lot of it coming on the heels of China maybe being not so excited about crypto out there. Of course, that's nothing new, but they just reiterated that, and that seems to, on top of the Musk issues with Bitcoin, all that seeming to weigh on the crypto space. All right, let's move on to some other questions here. This one comes from Jason. He says, hello, Jason. I listen to OBC regularly. You do great work. I'm grateful for you. Oh, thank you. We're grateful for you, Jason, everyone else who takes the time to send in your questions, to listen to the show, all the other fun stuff that you do. Keep it coming, rating and reviewing, all that fun stuff. He goes on to say, I don't think I've heard an episode on either, one, recommended options screeners and screening strategies, or two, recommended options prop firms. Have you ever done episodes or written articles on these topics? If not, do you have recommendations on them, or can you refer me to the material you trust on these topics? These are interesting. One's interesting, one's a little confusing. Let's start with the first one, the option screeners. This is something I've talked about on the show in the past. I said something I think we need to revisit on an upcoming episode, because I need to go and really get the lay of the land of some of the newer incarnations of screening tools that are available for you folks on a lot of the retail brokerage platforms. I know what I use here. A lot of this is pro-grade stuff and not really readily available to the audience of a show like this. But I've said it before, I use a lot of different tools. I like the live ball screeners. They're really good. We've done a lot of stuff with the folks over there at Trade Alert. Henry and his team are great. They do great. If I need to break down a specific trade and say, hey, what happened with this, then that's a great one for it. They have some screening tools in there as well that are also pretty good. And again, we do a lot of this for the odd block segment on our option block show, where we talk about a lot of unusual activity. A few criteria to look for. Obviously, opening is a big one people forget. We had our buddy, the Rock Lobster, suggest a cool, unusual trade on our show recently, and it was a closing trade. It was a closing covered call. It wasn't exciting at all. So opening is usually a good starting point, and then getting into some of the, changes in implied volatility. And there's a lot of ways I think you could set that up. So I think a good rundown on not only what we use, but also getting the lay of the land. I've used a number of them now, but not all of them. I want to go out and try all the different screening tools on the different platforms, and maybe we put together a nice list of our favorites, maybe what Dan uses out there as well, and kind of an updated version of here's what tools are available out there for you guys, free, what costs, and here's what we think you should use. So that's a great suggestion, Jason, something I've been mulling over as well. As far as the second part of your question, I'm a little confused what you mean by recommended options. Do you want to become a market maker? Is that your goal? Do you want to become a work at a prop trading firm? If that's the case, that's a little bit different now than it was when Dan and I got into this business. Obviously, they weren't even called prop trading firms back then. They were called market making firms, and there were a legion of them. You come out here to Chicago, you had your Wolverines, your Susquehannas, you had, you name it, Timber Hills, you name it. I was at a smaller firm. I went over to Stafford later. There were a bunch of them. Most of them are gone now. Susquehanna's still around. Wolverine's still around. A couple of the big ones still around. And what they're teaching you now is a little bit different than what it was back in the day, too. Obviously, you're not going down to a trading floor and stand in a crowd unless they're going to put you in the S. A little bit different. So you're going to be doing upstairs stuff, probably having more products than just what's available in a particular pit. So let us know also, do you want to become a trader? Or do you want to just know more about options prop firms? So, Dan, if you have anything to add, A, on the screeners, or B, if you can interpret what he's looking for on recommended options prop firms, have at it.
Yeah, I mean, you covered a couple of them. This is actually good timing. Next week, we're actually announcing a screener that we've been working really hard on. And oh man, it is great. If you're not on my email list, just go to my website and click on Join Free, because you will want to attend that webinar. It is a really super great screener that we're so excited to roll out. I could throw FinViz on there. I could throw Option Play on there. And then as far as the prop firms goes, yeah, I mean, unless you're wanting to break into being a professional trader, then who cares? Like, it doesn't really matter.
You can always go knock on the door of Ken Griffin, see if you can go work at Citadel, right? I'm sure they're very open and welcoming to newcomers over there. Option Play, I forgot about them. They're one that's available for the retail. Trade Alert also has the What's Trading platform. I'm not sure about the future of that now that SIBO owns it all, but that was a more retail bite-sized ones as well. So check out a couple of those. Those are retail priced friendly as opposed to the full Trade Alerts. That gets a little bit more for the institutional audience. But those two are something you could use over there that are more retail price friendly. Speaking of functionality, you got this comment. Dan, we rolled this out. It's interesting. I had forgotten about this, but we put out a tweet about this. Our app, a lot of you listen to our content through our mobile app. They added a new alarm function. So now if you want to wake up to me and Mr. Passarelli or whatever other show on the network floats your fancy over there, you can just set an alarm in the app and you can wake up to us talking about whatever nonsense floats your boats over there. So if you want that, have at it. A lot of people are chiming in, including a J4340. He's a regular listener, I do believe. He just wrote, "I love this!" ! So there you go, Dan. Folks are waking up to us every day. Does that thrill or perhaps terrify you?
I think it's great. I think it's really great. We love doing this stuff. Without listeners, we're just wasting our breath. So yeah, I love it.
I love it too. We love all your feedback. Keep it coming. We didn't even get a chance to scratch the surface on some of it today, but don't worry, there's more coming next week. All right, everybody. Unfortunately, that music means we have to get on out of here for this week. So again, let's recap. Covered calls, put them on at a strike. You're probably comfortable selling the stock. If you want to roll it, wait until it breaks through the strike and then roll it up and out. And that will usually help you with that. We can get into more down the road if we have time of nuances, how far up to roll and things like that. Obviously, that's a case-by-case type thing. But a good conversation to have, I think, for a future show as well. Before we go, Mr. Dan, if folks have questions, maybe they want to hear about this screener, can you give us any peeks behind the curtain into the secret sauce? What are you guys using? What are some of your criteria for screening, sir?
Well, this is specifically a momentum trading screen, and it's something that we've worked on for a long time, been teaching for a while, and then really dialed it in just over the last couple of months. And it's going to be great. You're just going to love it.
And if folks want to kick the tires on the momentum screener or your mentoring, anything else you have cooking, where should they go? What should they do, sir?
Yeah, so we are going to have a webinar on this next week. So this is such perfect timing. Just make your way over to markettaker.com and click Join Free. That puts you on our free newsletter, and you're going to get an invite to that webinar. And this is one for sure you don't want to miss.
There you go. markettaker2ts.com is the place to go on behalf of Mr. P and indeed myself. I thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in your questions. Keep them coming. We'd love to hear from all of you. And we'll see you back next week for another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.